What if I told you that the Federal Reserve may already be canceling your mortgage and that most Americans have no idea what's happening? Stay with me because what I'm about to share isn't hype, it's history. And if you understand it, you can position yourself to benefit. If you miss it, it could cost you. Right now, we're seeing headlines everywhere. The Fed's about to cancel 39 trillion in debt. Why inflation is secretly great for homeowners, and why keeping your mortgage may be the smartest move you can make. And honestly, there's real truth in some of that. But almost every one of those videos is missing one massive piece. And that missing piece is exactly what separates the people who come out ahead from the ones who got excited, did nothing, and still got left behind. By the end of this video, you'll understand what the Fed's actual plan likely is, how it affects your mortgage, and why doing nothing may not be enough, and the smartest move available if you qualify. Let's start with the basics. The Fed doesn't need to write a $39 trillion check. They don't need to erase the balance overnight. What they need to do is make that debt easier to carry over time. How do they do that? Three tools: lower rates, increase the money supply, and let inflation reduce the real burden. Now, let me make inflation real simple because this is the piece that most people gloss over. You know how a Michael Jordan rookie card, mint condition, is worth somewhere between $200,000 and $250,000 today? Part of what makes it valuable is scarcity. Only 339 of them exist. Now imagine if they found a warehouse with 10 million of those cards, printed, never circulated, just sitting there. What happens to the value of the ones that you already own? They collapse. You'd be lucky to get a dollar. That's inflation. When the government prints trillions of new dollars and pumps them into the economy, each dollar you already have becomes worth a little less. Not because your dollar changed, but because there are so many more of them now. And here's where it gets interesting for homeowners. You borrowed $400,000, let's say 10 years ago. That loan is fixed. It's locked. It doesn't care how many dollars the Fed prints. But the dollars you're paying it back with, those are the new, cheaper ones. The CPI data backs this up. What you could purchase for $100 in 2016 would cost you roughly $139 to $145 today. Prices are about 40% higher than they were a decade ago. So, in practical terms, if your income has kept pace with inflation, you're repaying 10-year-old debt with dollars that are roughly 40% cheaper in real terms. The mortgage didn't get canceled, but the real cost of carrying it quietly shrank without you doing a thing. And that's what people mean when they say inflation helps homeowners with fixed rate mortgages. And that's exactly the playbook the government has used before for their own debt. After World War II, the US federal debt hit roughly 106% of GDP. Many economists at that time feared America would struggle for decades. Instead, the government and Fed kept short term rates low, they allowed inflation to run, and they grew the economy. By 1974, that debt to GDP ratio had fallen from 103% down to around 30%. Not because they paid it off, but because inflation and growth made the old debt smaller relative to the economy. And many serious economists believe we're setting up for a replay of that exact same scenario, where the US federal debt is now back up to about 123% of GDP. So, why does this matter to you? Because if your debt is fixed in dollars, like a mortgage, inflation works in your favor too. Your payment stays the same, but over time, income rises, and that old fixed payment gets easier and easier to carry. And that's what people mean when they say that the Fed is canceling your mortgage. And again, there's real truth to it. But here's what they're leaving out: a low mortgage rate does not automatically equal financial security. I watched people lose their homes in 2008, people that had great rates. I watched people get blindsided in 2020. Why? Because their equity was trapped. They were house rich and cash poor. And when life hit, job loss, medical emergency, business slowdown, their mortgage companies still wanted that payment every single month. Cheap debt can be valuable, but liquidity matters. flexibility matters, and access to capital matters. Now, before I go any further, I know exactly what some of you are thinking. Mike, I locked in at 3%. Why would I ever give that up? And that's a fair question. And honestly, it's the right question to ask. Here's what most people don't realize. Rate and cost are not the same thing. Your interest rate is just one number on your loan. Your effective APR, your annual percentage rate, what you actually pay over the life of the loan, is a completely different story. Think about it this way. A traditional mortgage at 3% charges interest on your full outstanding balance every single month. Your deposits sit in a separate bank account, earning almost nothing. Your equity is locked up, your cash is elsewhere, and that 3% is quietly grinding away on a balance that barely moves in the early years, because that's how amortization works. That low 3% rate isn't paid back evenly over 30 years. It's amortized, meaning for the first 10 years, every dollar that you pay the bank, over 52% of that goes towards interest. Over the first 20 years, at a 3% rate, over 44% of every dollar you send in gets applied to interest first. The all-in-one allows you to pay principal first because it calculates interest differently. Your deposits, your checking, your savings, your cash flow work against your balance daily. That reduces the balance that your interest is calculated on. And when you reduce that balance consistently, your effective cost of borrowing can end up lower than your stated rate, even compared to a 3% traditional mortgage. Not because the rate is lower, but because the math works differently. And that's the difference between a great rate and a great outcome. Let me give you a real world example. I recently ran numbers for a couple with a $500,000 mortgage. It was a 30-year fix that they had taken out 5 years ago at 3.25%. They still had 25 years left on that loan. And here's what the analysis showed. By refinancing into an all-in-one at today's rates, their payoff forecast dropped from 25 years down to under 8 years. They saved over $122,000 in interest expense, and their comparison loan effective APR, 1.357%. Let that sink in for a second. They refinanced out of a 3.25% loan into today's rates and today's environment, and their effective cost of borrowing came out at 1.357%. Not because of a magic rate, because of how the math works. Now, I want to be straightforward with you. The all-in-one is not appropriate for everyone. Results like these depend on your balance, your cash flow, your income, and how you use the account. Your individual results will vary. That's exactly why I offer a free, personalized analysis so you can see your specific numbers stress tested before you make any decision. The link is in the description below. And here's why the all-in-one loan deserves serious attention. Because it doesn't just focus on rate, it focuses on total financial control. The all-in-one allows your deposits and available cash to work against your mortgage balance daily, reducing interest expense and shortening payoff dramatically. And unlike sending extra payments into your traditional mortgage, your money stays accessible. If life happens, you have breathing room. If opportunity appears, you have capital. And if income fluctuates, you have flexibility. That's not a feature, that's a financial posture. Here's another detail most people miss. The all-in-one is tied to SOFR, S-O-F-R, which stands for the Secured Overnight Funds Rate. It's an index that closely tracks the Fed funds rate. So if the new Fed chair begins cutting rates, like many expect, the all-in-one rate adjusts lower automatically. No refinance, no closing costs, no restarting a 30-year clock, no paperwork. Traditional mortgage holders typically have to refinance to capture falling rates. The all-in-one borrowers get to benefit automatically. And if rates fall faster than expected, the math gets even better. Now, what if rates rise? That's the right question to ask, and that's why we stress test every scenario. Modest increase, sharp increase, rates staying elevated longer than anyone wants. We run those numbers because the difference between a smart financial decision and a headline-driven mistake is math. Here's the bottom line. The Fed may very well be engineering an environment designed to reduce the real burden of debt through lower rates, inflation, and time. And yes, that can benefit mortgage holders, but sitting still may not be the best move. The smarter question is, how do I position myself to benefit the most while protecting myself at the same time? And for many qualified homeowners, the all in one may be one of the most powerful tools available to do exactly that: reduce interest, improve liquidity, shorten payoff, maintain control, and even benefit automatically when rates fall. If you want to see whether it could improve your specific situation, follow the link in the description and we'll run your numbers. We'll stress test your options and we'll help you make the best decision based on math, not headlines. If you found value in this information, please share it with someone you think could also benefit from having this information, and be sure to hit the subscribe so you don't miss out on future videos. Thanks for watching.